This conference will now be recorded.
Wow.
All right, we are going to do the poor man's covered call, and it's going to be a presentation by Lenny. And I'm going to give control to Lenny in a second here, and Lenny's going to take it from there. It's all yours, Lenny.
All right. Let me go ahead and. All right. So, everybody see that? What do you see?
I see my favorite person.
Okay. So everybody sees that. All right. So that was just something I threw together real quick. It's Jack Nicholson laughing at Jim Cramer's stock tips. And so we're going to do. Okay. I'm going to try to make this last less than a half hour. Right now it's about 7 after. I'm going to try to keep it at that. I would like to hear some feedback from Steve Zoller if you have some time here, because you said you've been doing this for about 2 years, and I've been doing it for maybe about 4 or 5 months. So I'm sure you'll have something good to contribute here.
Okay, I'll just chime in if I have anything to add.
Yeah, and if I say something really, really wrong, chime in, because I'm using that. And it would probably be best if everybody went on mute until you have to say something. If I say something that you don't understand, interrupt me immediately, because I'll clarify it for you. If you have a question about something that is somewhat remote, or maybe it's a little bit off topic, then we can wait until the end, and then we can do a Q&A. So right now, I'm going to ask everybody to go on mute, just to cut down the background noise, the hungry cats meowing, and the dogs. And I'll start going. Okay, here we go. And I am going to start off with the first slide here, basically. And can you see that? Basically, my first slide on the poor man's covered call, just to illustrate what this thing is that we, instead of buying the stock, actually, let me go up to the top here. And let's just compare the differences. You can buy, for example, my big, the stock I'm going to be using the example of a lot is Intel. I bought a Intel 45 call. I open it here, and it goes all the way to 17 January 20, and that's where it expires. But I bought that for $580. I could have spent $4,500 on it, but I spent $580. My goal is to make $100 a month. This is the way I do it. I can $100 a month divided by 580. I'm making 17% monthly. That's nice. Even 2.2% monthly is nice. How do I get 100 a week? I try to get a minimum of 0.28 for 1 week, or 0.53 for 2 weeks, or 0.78 for 3 weeks, or 103 for 4 weeks. Reason I use these numbers is because we got to subtract $3 right away for the commissions when we roll one over. So here I have my base call right here. That's good for a little over a year now. What I'm doing is that I am selling at a 48. Let me increase this so you can see it. I'm selling a 48. I open it here and I close it here, maybe 1 or 2 weeks at a time. And in the meantime, the stock has been going up. Then once it expires, or I roll it out, I open up another one, and I sell this one. And the stock keeps going up. Sometimes it goes down, which is fine. And I continue along like this. And eventually, what will happen is it'll go up too steep, at which point it comes up like that. When that happens, I'm in the hot zone. This short call is in the money, and it's working against me. Many times it'll come back down, and that's good. And if it comes back down somewhere around here, then I'll just go ahead and roll out another one. Now, let me bring over another slide, because when this goes in the money, then you're going to have something you got to deal with. You can't just let it sit and expire in the money. I'm hoping here that you're familiar with a risk profile. I'm going to show it to you if you're not, but I'm going to show it to you anyway. And this risk profile, which you can use in the Thinkorswim Analyze page for a poor man's covered call, it's actually a diagonal spread. Your profit line is going to be running in this curve. This other line here just shows you where it's going to be at expiration. This expiration profit line is not that much, it's not that useful. It's the current expiration. This long arrow indicates the stock price. So when this call goes up in the money, it's working against you even more. That's when your stock, your profit line starts to go down. At this point, you can make a decision to either roll out another one or just to close out the whole trade altogether. First of all, let me look at my notes to make sure that I am going in the correct sequence. And
Lenny, can I interrupt you for a second?
Sure.
It might be useful to some of the people here, including myself, if you would just go back and maybe you kind of jumped in the middle, quite frankly. I mean, we don't even know what a poor man's covered call is.
Okay.
Yeah. I mean, you kind of jumped into what you do, which is great. But
okay,
let's go back and kind of understand what a poor man's covered call is, and with this graphic that I'm looking at now, maybe explain, you know, how far out you're going with the call.
Stand by 1 minute, and I will get to that. I got to take this one. Hi, what you got? I'm on a conference call right now. I'll take it. All right, thank you. Bye-bye. I apologize for that. I was afraid that was going to happen, but when money calls, I answer. Okay. You there?
Yeah, I'm here.
Okay,
So
very good. I apologize for that interruption.
Let's go back to the first slide, and you know, you're making the assumption that we all know what a poor man's covered call is, and you're making the assumption that we know what these numbers are. So what are these numbers that we're looking at here?
Okay. These numbers up here would be if I had purchased 100 shares of Intel at $45 a share.
Okay.
And then this is the normal way of doing covered calls. You buy the stock, and then you sell a call against it to get some premium. This is a regular covered call. Let me just... I'm glad you called that out, Gil. This one, where I just bought a call option, a 45 call option long term.
Okay, so how
You don't
far
have to
out do
buy.
you typically go? How far out do you typically go when you say long term?
I like to go at least a year.
Okay. Yeah, I just want to put some,
Yeah,
yeah, okay. So you go out about a year. Okay, great.
I go out about a year.
Okay.
Then sell short-term calls above 45. In this case, I'm doing 48. Is that clear?
Yeah, now it's very clear.
Okay. If I did not buy either the stock or the lower strike call, then I would be selling naked calls. And I don't have the skill, the money, or the courage to do that. Because if you sell naked calls and the stock goes up, you have an infinite risk. And the brokers won't allow you to do that unless you have special credentials and a whole lot of money. By only having to outlay the cost of the long-term call, in this case it was 580, I can still get the same premium as I did if I had bought the stock when it comes to selling the short 48 calls. Does that sound clear?
It's clear to me, but no one else can see.
Okay. If anybody has a confusion on that, please unmute yourself and ask the question. Okay. So you have to have some sort of coverage. It's either going to be owning the stock or owning the call down here for selling these calls up at 48. Because if you ever get exercised, you've got to have some way of making good on your obligation. And if you ever got exercised, and we're going to go more into this later, let's say I got exercised at 48 and the stock kept going up, I could always exercise this long call, which is my right to do so because I bought it, and buy the stock at 45 and replace it up here at 48. So I'm covered. Can I
So you in
move on?
essence roll it? So you in essence roll it?
If I got exercised at 48 right here,
Yeah.
then I couldn't roll it anymore because my obligation is done, and this short call now no longer exists. It's been exercised against me, and it's tried to take my stock, but I don't have that stock in my possession. So then the broker or myself would exercise the 45 because this is definitely in the money, the 45, and I could then exercise my right to buy the stock at 45
Okay, I got you.
and then sell it at 48.
Yeah, I got you.
Okay.
So you're still
So-
going to have the money. So you're still going to have the money to do
You're
that.
still gonna, well,
Lenny,
no, actually, you don't have to have the 45. What's going to happen, and I don't want to get ahead of myself on this. Was that you, Steve?
no, that's me, Dave.
Dave, okay, Dave.
If you sell it at 48, then don't you lose 280 bucks?
Because that's a profit. I can sell the call. Yeah. Would I lose $280? I buy it at 45 and I'd sell it for 48.
Cost you 580.
Yeah. Okay. I didn't want to say this now, but I'll say it. What's going to happen is that if it gets called at 48, you're in a short position at 48. You buy it at 45, you return the stock, and then you're actually closing out. You're actually closing your short position. I'm going to have to do some numbers on this one. That's the way it was explained to me by the broker when I called them. I'm going to have to do some numbers on this and make this clearer. I should do that and post it because this one's not easy to explain.
Yeah, but that's the part that's important.
Oh yeah.
Yeah, that's the tricky part, you see. Because if that happens, then you would, like Dave said, you'd be down, and then you would have to at least have made that difference in all of the calls that you sold up until that point.
Yeah, those
Right.
are some numbers to work on.
Because you also have to count the amount of money that you made selling the calls during that period before the stock went above the 45 on the call that you bought. Because
This is Steve.
that would also offset. Now, Steve, what do you think?
Yeah.
Well, I can't do the numbers in my head here for this, but let me tell you conceptually what happens.
Okay.
Because I do exactly what Leny does, except I think about my strike selection differently. I probably make a similar strike selection, but I pick them based on delta rather than dollars per week, which one can argue is better or worse. But fundamentally, as you know, when you sell a call on a covered call, your delta is typically 20 or 30. I mean, it depends on what strike you select, but it's something in that kind of range. And when you're buying a call here for the long call, you're buying a call that's somewhere like a delta of 50 up to maybe 90, depending on how you choose to implement your strategy. But whatever way you do it, your long delta is always at least, say, double-ish your short delta. So as the stock price goes up, obviously your long call goes up faster than you're making money on the long call faster than you're losing money on the short call, because say the long call is 60 or 70 delta, when the stock price goes up $1, that long call makes 60 or 70 cents. If your short call was 20 or 30, it loses 20 or 30 cents. So at the point in time when the stock price has gone up such that you might get exercised on that short call, your long call has made more money at that point in time than your short call has lost. So when you start talking about, well, gee, what's it going to cost me to sell the long call? Well, what you really would have to look at is what, as the stock price has gone up, the long call value has been going up. And so what would be that long call value at that point? So that's why it's not a simple little math thing here to look at, because it's constantly changing. But what you're fundamentally trying to do, this is a bullish play. You fundamentally want the stock to go up because your long call is going to increase in value. And as Leny put at the top, his $4,500 versus 580. I think I quoted last week that your leverage on these things is usually 5 to 10 or 5 or 10 to 1 versus owning the stock. And so his is what, about 8 or something here. So it's classic. You're much more leveraged so that the value goes up 5 to 8 to 10 times faster than if you owned the stock, and your short call is losing some money. So, which is what you want, because that's how you make money on these things. And that's why Leny can't give you an exact number, because when that stock price goes up, all these other, your short and your long options are going to be changing value continually.
Well, that really is the problem, or one of the problems with this, because you can't really determine what your risk is.
Well, but I know as long as my long call has a larger delta than my short call, then I know when the stock price is going up, I'm making money. And if the stock price is going down, it means I've got the direction wrong and I'm losing money, which
Right.
is why on these poor man's covered calls, if you have the direction correct, you make a whole lot more money than you make with a standard covered call. And if you have the direction wrong, you got to have a plan for getting out, because you'll lose money faster also.
Yeah, yeah, yeah. So in other
So
words,
for
when
the
you pick these, you really have to sell the call. Let me think about this for a second. You'd have to sell the call that's worth more than the extrinsic value of the long option.
You may be right. I think about it, for me, just thinking about it as delta is a whole lot simpler. That as long as my short delta is smaller than my long delta and the stock's going up, I'm making money. And the second I call it inverted, meaning if it gets to be such that my short delta is larger than my long delta, which is where Leny was heading, that if your short gets in the money, you got to do something with that short.
Yeah. Okay.
Preferably before you get in that situation. And you
Right.
can see, and unless this thing is another Tilray, you can see when you're heading in that direction if you know where to look. You want to take some preemptive measures on that.
Yeah, the only problem is I guess one of the other problems is the if this thing really just shoots up, but that's always a problem, I guess, right?
That's always the problem. And, if it's going to go to the moon, I know what I might do. One option I will take a look at is just buying back that short call. If I'm convinced that this is turning into a go to the moon delta move, I'll just buy back that short call, and then just make it a pure delta play with that long 45 call. That's one option.
Yeah, Leny, I do the same thing. Over the last 5 years that I've been doing these, given this bull market we've been in, I call it naked, meaning uncovered, where I just have the long call at least as much as I'm covered, and probably more often than I'm covered, because it's just like a covered call on a stock. If you really think the stock's going up, the covered call is questionably helping you. So
Yes.
I go
Yeah.
naked a lot on these.
When you say naked, you're not talking about naked short calls. You're talking about naked on the long call.
Oh yeah, because I'm talking about if it's bullish. So
Okay.
I've bought a long call, so
Yeah.
that's the one that's going in my favor.
Okay, yeah.
Okay.
And
All right,
yeah, go ahead.
no, I was just going to say I didn't want to really interrupt, but I thought that was an important point to make.
No, it was. I'm glad you brought that up because I just
Okay.
I didn't do that. So, and if you're heading in that direction, let me bring up a risk profile. This is an Intel. This is as of market close today. This line from left to right is an increasing stock price. I'm sure anybody not familiar with a risk profile?
Yeah, I think you should go over it, Len.
Okay. All right. Yeah, there's a couple of things I want to go over with. First of all, this line up here, this blue line, is really only as it applies to expiration, and it's not really that important. And I was reading where most beginners in options put too much emphasis on this, whereas this is your current P&L as it sits, and this is how much profit you're going to have. You see these numbers moving as I move the slide bar over. So right now, Intel's at 48.60, and it's slightly in the money. And this says I have $187.51 profit. That's not correct. And I'll show you why a little bit later. But there's a couple other things in here. First of all, you got your break-even lines right here. Let me there's your break-even points. And this light area is representative of a probability curve, in that by this date, 1/26, which is a Saturday, that's settlement date for options, that until this date, there is a probability that the stock can be anywhere in this range. Now, if you look down here, there's a date. This is today's date. This is the expiration date. This is today's date, and we can advance the date to see what our profit line is going to look like. So I'm going to click, let's say, tomorrow, and the next day, and the next day, all the way up until the 25th. And as time goes on, my profit is increasing. Now it's $219 or $220, up until it expires, and then it's done. Or you roll it out. I'm going to make this go to today. Now, the reason I said that this profit is incorrect is because it is only looking at the current trade that I have. It is not taking into account for the calls and the premium I have collected earlier. Let's go show you a.
Does it take into account? Does it take into account the amount you paid to buy the call?
Yes, it does.
Okay.
Yes, it does. But it's only looking at the current short strike as well. It's looking at both. Let's take a look at this area down here. I'll show you how wrong this thing can be. Here's Canopy Growth Systems. I've been selling puts on this since September. The last put I sold, this is a naked put, was at $12.90. It's now worth $1.90. So this software is saying that I've got an $1,100 profit. No, I don't, because what it's not taking into account for is what I had to pay for the previous call to roll it out to this one.
Yeah, I got you. Yeah, you have to keep that separate on the
So this is only good for the current trade, and if you have a multi-step position, such as selling calls or selling puts, then this is not going to be accurate. And what you're going to need is a spreadsheet.
Yeah.
So I just happen to have one right here. Let me bring it up. And this is the spreadsheet I use to keep track of my trades on on this one. This one's set up for diagonals. I got a template here, and this is my Intel. I spent, Gil, was that you that just sent me?
No, I didn't do anything.
Thank you, Dave. Yeah. Yeah, I couldn't cover them all up, Dave. So anyway, let me go back to this. The top half of this spreadsheet is all the purchases I've made. I first did a buy to open.
Right.
And can you all see that, or should I enlarge it?
Yeah, no, it's good here.
All right. Tell you what, let me just do this in case somebody can't see it. 125. There we go. So this is all the money I've spent, and these are all in negative numbers. These sell premiums are all in positive numbers. For example, I sold this one, but I really got $98.50 for it. This is accounting for all commissions. My commissions is $1.50 per option per trade. So if we take a look, here's our option commission where you can set it. Maybe you pay less. And we can see there's a dependency on this with every one of these calculations here. So if we take, this is my cost basis of this $581.50 call is now down to 58. And everything in between I've collected is premium. If I double click this, you can see that it just sums up all the positive and negative numbers. And that's how you keep track of where you're financially at in this position. I created a little widget down here. I don't need that. I created a little widget here with the current long mark price of this long call and the short mark price of the one that I have, well, my short call. And then it also adds this negative number, which is this, and then this tells me how much my final profit is if I were to liquidate this right now.
So right now you have a January 19 call, or that already is expired? That already, no, that's what you currently have, January 19, January 25th?
Yeah, 17 January 2020 call. It's got about over a year to go. So if I sold the call, bought back the short one, which I'd have to do, add that to this negative number right now, then that would be my final profit. Now, as I continue selling calls, this negative number is going to reduce down to 0 and eventually going to go positive. And that's, now I'm making money on this call just from the premiums alone. I've already paid. In other words, once this goes to 0, this long call has been paid for by the premium.
Well, let's go one step here. Let's look at your very last sell to open call.
Mm-hmm.
If you were to roll that now, right? Because that's what you do, right? You basically.
Oh yeah.
Yeah. Okay. So if you were to roll that now, I'm looking at an option chain right now. It would cost you, let's say, $1.70 to get out of it, right? Because you got to buy it. You got to buy it, right?
That's right. You got to buy it.
Yeah. So you buy it at $1.70, and then you're going to sell 48 at around $1.90. Okay. So that's 20. I don't see how you're getting such a large sell price on I don't.
How I'm getting a large sell price.
Yeah.
Well,
how are you getting such large profits on one position?
well,
I mean, I'm sure you are. It's just that it seems those numbers seem pretty high for Intel to be 3 points off, because all you are 3 points off your buy price, right?
Well, yeah. Sometimes I get good. Sometimes I get good prices. Sometimes I don't. Let's take a look at this 18 January right here. I had to buy it back. Let me see. I had to buy it back for $1.14. Wait a minute. What happened here? 18 January. Okay, I had to buy this back. $1.14. Yes, that's right. Because this thing was starting to, where I sold this thing at 92, but then I had to buy it back at $1.14. That may seem like a loss, except that I then sold the next week out for $1.92. That was starting to move up in price, and at that time I did this, it was in the money. That's why I had to buy it back higher than what I sold it for. But then I was able to sell out the next week at an even higher price.
Yeah. Do you keep track of the actual price?
Oh
The
yeah.
actual stock price? That's not on this chart, right?
No, this is not on the stock price. This spreadsheet was designed to keep track of my profit.
Yeah. No, I see that. No, it's great.
Yeah, I didn't want to put in too much information, and I'm the type of person that would, so I had to fight my normal tendency to overcomplicate it.
Yeah. So now Intel is at 48, so you're basically underwater, right?
Yeah, I'm in the money. I'm in the hot zone.
Yeah.
And I have to manage that.
Yeah. So how would you go about managing that now?
I'm going to get to that a little bit later.
Okay.
But yeah, that's I can't wait to get to that part.
Okay, good. No, you're doing
Okay.
great. That's
Gil,
great.
All right.
the one thing I would add here to what Leny has said is that if you'll think back to that very first sheet that he had where the buying the long call was about 1/8 the cost of buying the stock. So if, for example, if somebody were doing a covered call on Intel, and let's just say for sake of argument, they managed the short call exactly the same as one another, which they might, then the only difference between the profit and loss between the covered call and the poor man's covered call is what happens to the long call relative to what happens to the stock. And since it's leveraged 8-to-1, that means on the first $100, let's say that somebody would make on the covered call, the person doing the poor man's covered call would make roughly $800. And so when you start thinking about, well, gee, this seems like a lot of profit for Intel, well, it may be because you're thinking of it as not leveraged 8-to-1 compared to how you might normally think about a covered call.
Okay.
Mm-hmm. Thank you.
Okay.
There's no way I could have said it that good. All right, so I'm about to leave this spreadsheet right now. And let's see here, let me just follow my lines. And let me bring up another slide. So I'm going to bring that one down. And I'm going to go to slide 3. This is one of the things I like to do when I'm considering a poor man's covered call. This is something I did yesterday when I got into the Morgan Stanley diagonal, and I had 635 days. I like to subtract out the last 180 days. When it gets down to the last 6 months, I'm going to look seriously at just closing the whole thing out. If I can take 635 minus 80, then divide all of that by 30, that's going to give me 15 30-day trades. If I can get $100 for each 30-day trade, we're looking at collecting 1,500 in premium. And what I've been finding so far is that, and let me go back to my, where's that previous slide? This one right here. This getting a 0.28 for a week, I usually do much better than that if you play it right. Yesterday, I rolled out an Intel covered call, and I actually got exactly 78 for it. I made 75 bucks, but it was only for 10 days. I extended my short call out 10 days, and I got $78. It's like getting paid for 3 weeks for doing 10 days work. So this is conservative, but I'm finding that it's usually doing much better. But this is one of the basic calculations I want to make because, you know, if see whether or not it's worth it or not. So let me move this over here. And so one of the things I'm going to do is I'm going to test for credit. Testing for credit is where I will, even before I get into the trade, I'm going to do something. I'm going to create a reverse calendar spread. A reverse calendar spread is the opposite of a regular calendar spread. I'm going to buy the near short strike and sell the far strike. I'll just put this in the Analyze tab, so I'm not really going to do it, but I want to get a feel for what kind of credit I'm going to get. So this, because this, what you're seeing here, this calendar, is what you're going to see when you roll one over. You're buying the near one, and you're selling the far one out. This has got a credit of 78 right here. These numbers should add up to that. Maybe quite not, because this was when the market was open and numbers were changing. So does everybody follow me on that one? Because this is important.
Yeah.
Yeah.
Okay, very good.
So is that what you're going to do now?
Yeah. Now, you were asking me about how I keep track of how I get this kind of money from these. You know, you seemed like it was, you know, like I was making too much, or you know, that it was kind of high. Well, what I do is I can watch. I did this just this morning. Right after the market opened, I was watching the. I opened up a roll in the Analyze tab, and I was just watching the price fluctuations. And after the market opened, if I were to roll it out, I could get $36. But by the time a few hours passed by, that credit had risen to 78. Why? Because this price up here that was in the hot zone, was working against me, lost steam, and it wasn't working against me nearly as hard. And if you can take that liability and defuse it with not only the stock price dropping during the intraday, but also it's got time working against it, your credit can fluctuate. As I said here, the market tried to rally Intel past 49. That seems to be a bumping point. That's a resistance point. It failed twice. The market gave up, went home. They went looking for something else to pick on. So, and I also watched that in conjunction with the sector, in this case technology, and the broader indices. They all seem to kind of go up and down together to some extent. If I have to get up and go somewhere, or if I'm not going to be around, what I'll do is I'll pick a credit that I want to roll out for. Let's say I'm going to roll it out for a week. I did this last week on Intel, and I said, you know what? I want 40 bucks. I don't want 25. I want 40 bucks, and I think I can get 40 bucks. So I put in a good till canceled order for .43 for that rollout credit, and I got it. So instead of 25, I made $40 for the week. So watching this, turn on the 1 minute charts on Thinkorswim, and then open up in the Analyze tab, or a rolling order. You don't want to set it. You don't want to execute on it yet, but just have it in the order page just to watch the fluctuation right here. And make sure this lock, you see this icon of a lock right here? Make sure that icon that is unlocked. That way this will float. And you can watch how it fluctuates during the trading day. Okay?
Let me ask you something, Lenny. Do you worry at all about earnings?
Yeah, I always worry about earnings, don't you?
Yeah, because you basically have that liability, right, all throughout doing this. I mean, if you're going out, a year, you've got 4 times during that year that you can basically get blown out, right?
Yeah.
Right?
Yeah, that is true.
Okay.
That is true. And that kind of leads me to what I'm going to be talking about next. And there's two things I'm worried about.
Not to mention news.
Not to mention news. Yeah, that can happen. That can happen when you own the stock too.
Yeah, but if I own the stock, at least I'm getting dividends on it.
Yeah.
There's no difference between owning it and doing what you're doing, really, except the amount of money that's being laid out.
Yeah, well, you're leveraging it.
Yeah.
You're as far as
you don't have liquidity either.
Yeah, as far as your ROI goes, this has a better leverage for it.
Yeah, oh, absolutely.
So, I'm glad you brought up earnings, because this is really going to the stability of this company. And, so far we've just been looking at the options, but what about the underlying company that is underlying the stock itself? And this brings me to finding a value. And we're going to do something now. Hold on, please. Hold on.
Well, I do like the way Steve approaches this in terms of the delta. I think that's I think that's important.
Oh, it is very important.
Yeah, that's like real important.
Oh, yeah. Just one of the things it's one of the big things to consider.
Yeah.
But also volatility plays a part in it, because that's going to.
You have no control over that.
Yeah, you don't.
You can't. You have no control over certain things. So the more things that you can eliminate that you have no control of, seems like the better shot you have at making money.
Yeah.
Yeah.
But time decay is your biggest friend when it comes to getting rid of your short strikes.
Yeah. Oh, go ahead. I'm sorry. Go ahead. No, go ahead.
All right. So let me do something now. What I'm going to do here is this. I have a Fidelity account, and this is where I get this information. Now, if you don't have a Fidelity account, you might want to consider one. I'm not saying switch brokers. I'm not saying even do any trading in it. You can get a Fidelity account. You can open it in 10 minutes. You can fund it with a couple $100, and you'll make more in there than you will in your checking account. And I have 2 Fidelity accounts, and I have some TD Ameritrade as well. But I've got one Fidelity account. I just use it as an extension to my checking account. I don't do any trading in it. I just park my cash in there, and I get more. I get more interest than what Bank of America pays.
What is that? What is that called, Lenny? And how much interest are you getting on that? I'm kind of interested in that.
Yeah, you could just open it, go to
Well,
Fidelity.
that
That's
is-
called an individual account.
Yeah. And then where do you put it? Is it put somewhere, or it's just in a cash account?
Yeah, it's just a cash account.
Okay. What kind of
Yeah,
what are you returning?
I'd have to look that up. We had this conversation a couple of months ago, and found out I was getting 4 times in Fidelity what I was getting in Bank of America. I mean, it's not that Fidelity was super great.
Really?
It's just that Bank of America was just ripping me off.
Yeah. Well, they're ridiculous. I mean, is it more than 2%?
What, Bank of America?
No. The Fidelity account.
Oh, the Fidelity, yeah, it's more than 2%.
Okay.
You know, and in fact, I was just counting it as basis points per month. I mean, you know, the interest rates are still so low that sometimes if you're going to look at it per month, I just count it in basis points. But let me take a look at a stock here. I'm going to open up one. Oh, let's say it's somebody give me a stock.
Microsoft.
MSFT. That's cheating. That's a good one. Okay.
Well, I want you to be successful.
All right. This is to illustrate what I've got here. And now that I have Microsoft, I'm going to go to earnings. And this is when I'm thinking of a stock, the first thing I want to do is I want to see what kind of earnings it's got. Why? Well, because Warren Buffett does it. Yeah, and it's one of the first things he looks at. If it doesn't have a good earnings track record, he's not going to look any further. So I'm going to do the same thing. And so I clicked earnings, then I clicked earnings detail, and now I come down here and I click view more. And I've got 40 quarters of reported earnings here. Estimate, GAAP, and reported. Now you're going to love this. I click, hold down control, click, go all the way down to the bottom. 40 quarters, last 10 years, control C, copy. I'm going to bring up my spreadsheet called Earnings and Critical. Both of these were shared on the group today. I have a template. I don't want to do anything in the template, but I am going to hold down. Now I have template 2. This is the anchor point right here. I make sure that's my active cell. Control V to paste. And that tells me whether or not I want to look any further. That's got a good earnings track record, good earnings. Then I'm going to go ahead and I'm going to save this name to MSFT. If I didn't like it, let's say it looked like J.C. Penney's or this one, I would just hit Control Z, undo the paste, and I'd go on to the next stock. As soon as I see something like this, Control Z, unpaste it, let's find another one. Now that I've got this, I can then, and I'm not going to go into the detail now, I can do all of this at another time, but what I will then do is go into the financial statements, because we're just trying to establish some value here. And I can take and copy this information or certain pieces of it into these areas down here. This area here is something I created after reading Peter Lynch's book about debt minus cash divided by equity, and it gives you a certain benchmark to go by. This area over here, I plug these numbers in, and it gives me total assets minus intangibles equals liabilities. Total assets minus intangibles, yeah, equals liabilities, but then, or minus liabilities, and then I get equity. What this thing down here does is this gives me my Benjamin Graham safety margin. Benjamin Graham came up with the safety margin calculation years and years and years ago. Benjamin Graham you probably know who he is. He's the mentor and professor of Warren Buffett back in Columbia University.
Lenny, aren't these metrics that you're using right now really designed for people that want to buy stock and hold them? More so.
Yes, that can be, but this is going to tell me just how stable this is. And if it's been beaten down in the marketplace, if it's a good value stock, and it's been beaten down in the marketplace, when you have good financials like this, you can have a certain amount of confidence, a good amount of confidence that it's not going to go much lower.
Can you explain the chart and the lines on the chart?
What, this chart here?
Yeah.
Okay. Yeah, let me do that. In fact, let me find one where it sticks out. Okay, MD. I'm going to do some more evaluating. You can see I don't have any numbers right here. I have a legend right here. This yellow is the reported earnings. The purple or the magenta is the GAAP earnings. These are the ones I like to go by. And this dark line is the estimated earnings. Here, I'm going to show you something real quick.
All right, so if you go back and you look at Microsoft, it looks like that they missed earnings quite a few times, right?
Yes. Yes, they did.
Why would that tell you? So why would that tell you that that's a good one, or is that telling you it's not a good one? That's why I asked you.
An occasional miss happens. Good companies occasionally miss.
Looks like they missed more than they actually beat, right? Well, they got real close.
Well, as far as the estimates, I'm not really worried too much about the estimates. What I'm concerned about is a good earnings increase.
What about the average earnings? What about the average P&E against the current P&E? Have you ever looked at that? The average P&E, let's say over 5 years versus, the current P&E. Wouldn't that indicate to you if the current P&E was lower that might be a good buy, and just make it simpler?
Yeah, there's a lot of things that you can do.
Yeah.
And you have an expression that I've started using now. You know what that is?
I don't know. Does it involve cursing?
No.
Oh,
no,
okay.
No, you said it a few times. Too much work.
It is too much work, yeah. It is.
And no, I picked that up from you, Gil. Because, and I'm going, well, you know what? Maybe he's right. Maybe it is too much work. So let's see if we can simplify this.
I say it's too much work because I'm embarrassed to say I'm too stupid to figure it out.
So there's got to be some way of determining just the stability of it.
Yeah.
As opposed to something like like that.
Yeah.
Well, actually, pennies may be coming back, but that's still nothing I want. Nothing.
Yeah, I saw the legend on the side, and of course I can read it. But when I saw Microsoft, I was a little surprised actually. So it showed me something that I wouldn't have guessed.
Yeah. Here's an interesting. Let me take Nike. This is an interesting one here. NKE, and I'm going to do earnings. and earnings detail. I mean, after
Lenny.
you've done this 100 times, you.
Lenny, this is
Yes.
Dave again.
Hey, Dave.
Yeah, he asked a question about the average 5-year PE, and before you moved on to Nike, I just wanted to say you can determine that on the Fidelity if you go to the key statistics.
That's right.
Yeah, it's on Thinkorswim. It's actually you can do
You
it.
go to the key statistics.
Actually, you can
right
do it right in
there.
the scan. You can do it right in the scan. It'll just bring it up for you. In fact, it'll do a side-by-side comparison, and if you want, you can just download it. And
Oh, yeah. These key statistics are great.
yeah, well, yeah.
So let me go back to, there's a lot of good information all over the place. I'd sure like to get it all in one central repository.
Mm.
But without any extraneous difference, additions here. All right, so let's take a look at Nike. I'm going to copy, go back to the spreadsheet, and I'm going to plug it right in here. Now, you wanted to know about these two different lines. Look at this. Nike, this is the reported earnings. This is the gap. I go by gap. I don't care about reported. This is my mainstay right here. They kept going up, and you notice how then it started coming down. Well, during this period of time, Nike stock was going down until it met this area right here. It bumped up, Nike stock jumped up and made everybody talk about it on CNBC. I could see this happening. I actually bought a call about this point and, made a fast couple $100 on it. So when you see these different lines diverging like this, somebody's playing with the stock price. They keep reporting more than they make. It finally comes down to meet it. And as a result, the stock price came down too, when in fact, the gap earnings, the real earnings, were going up. A lot of smoke and mirrors on Wall Street. That's what I wanted to point out.
When was that? Do you have a date on that?
I know it was over a year ago.
Okay.
I know it was over a year ago. That's when I first, I just stumbled across it. So anyway, with this information, you can get a pretty good idea of whether or not, you have a stable company or not. And I'm going to close out of that now unless somebody else has a question. All right. Now let's talk about some of the dangers involved with this. And one of the things I like to do, Steve Zoller left, too bad. One of the things I like to do on my Thinkorswim graphs is I create these little boxes. It's a corner. I call it a short corner. The reason is because I want to see what the stock price is in relation to my position. This vertical line is expiration. This horizontal line is your strike price. As you can see, Intel is in the money. It would be nice if everything was wonderful and sweet and would just stay right in this area and break through the wall before it breaks through the ceiling. Well, not always. Here's another one. You're going to like this one, Gil. This is CGC. I've been selling puts on this thing since it was up here. Then it dropped down here. It broke through the floor. But I kept selling time out in front of it. If you're going to be in the money on these, on any short strike, you want to have a lot of time out in front of it. Not too much time, but enough time to make it not worth an early exercise. That's what I'm afraid of. I'm not going to let this thing expire in the money. I'm going to do something. I'll close it out. I'll roll it out. I'm not going to let it expire. But it's the early exercise that has me concerned, has me a little scared. So that's why I take the precaution of always making sure there's some time out in front of it. Why? Well, because if there's a lot of time out in front of it, then the person who holds that long call on the other side of my trade is going to have to forfeit that time value. Once he exercises that option, he has forfeited his time value. And let me open up another one.
You using Thinkorswim for that?
Yes, I am.
So is that a special drawing tool, or are you just doing horizontal and vertical lines?
No. This is a drawing tool.
Oh,
Hold on, let me open this
called?
up. Okay, let me open up a chart, and let's put in IBM. Okay, come on. There we go. You know, we used to have a drop-down menu. You just hover the mouse up here, and your drawing tools would just drop down. That doesn't work anymore.
Yeah,
I don't mind telling you, Thinkorswim is starting to get me mad here.
Why does it work? Well, you can keep the drawing tools up all the time.
Oh, you can?
Yeah.
What, you mean always up here?
Yeah, always where it used to drop down.
Yeah, because it used to be, well, I don't want to get into that right now, but these drawing tools,
Well, it
it's
still
gonna
drops
be-
down. I don't know. It must be one of your settings because it still drops down.
does it?
It does.
All right. Well, then I'm pulling them back because that gal did not know how to fix it. She goes, oh, it doesn't look like it works now. Well, have a great day.
Well, I don't know. I'm online right now and it's working. So.
Okay, very good. That's encouraging.
But
So
anyway,
this is my price level, and this
Yeah.
is my time level. And this is what I make them with. Price level, time level.
Oh, I got you. All right.
Okay? And that's it. And that's
So it's two
just
separate.
so
Yeah.
I
It's
can,
two separate. It's two separate functions.
yeah.
Yeah. Well, that's what I was asking. Okay.
Okay, very good. Yeah, because I just want to be able to see at a glance, where I stand with my short option. I'm not worried about the long option.
Yeah. Okay.
Okay. And before we go any farther, I think we've done credit fluctuation and testing for credit and dividend risk. This is the one. In fact, I'm going to open this for editing here. And I'm going to bring it into here. And this is something I learned on the swim lessons that you can get through Thinkorswim. If when you're approaching dividends, it's like you've got danger coming over the hill, and you got to be ready for it. Because if the dividend is greater than the time value of option, you're at high risk for early assignment. So the holder of the option will exercise just before ex-dividend, get the stock from you, and then collect the dividend. However, if you roll out for enough time, then it won't be worth it to forfeit that time value for the dividend. So if the time value is greater than the dividend, then it won't be worth it to him. The other point to make on this is that the holders of the long call are two types of holders. Those who intend to sell the options, and they're going to sell it. They're going to sell it pretty soon, prior to expiration. Otherwise, they're not going to sell it for as much. But those who intend to exercise the option with the intention to exercise it, They can hold it right until the last minute. So by keeping enough time out in front of that option, it's not going to look as appealing to exercise. Does that somewhat make sense?
Sure.
I should have rehearsed my words.
That makes sense.
Okay. The other thing is that, and this is a big gotcha, when earnings are coming around, or dividends, if you're exercised, you're going to be in a short position. And if you're in that short position on ex-dividend day, then the dividends are going to come out of your account. So I've got dividends sometime after next week. Intel's going to announce a dividend. It's got an ex-dividend day following about 10 days after earnings. I'm going to be making sure that I've got enough time on my option to discourage most to discourage the exercising of that. Sorry, I think my blood sugar is running low. I'm starting to fade out here.
No, it's fine. That's good. Yeah.
Yeah.
Okay. If you want, go ahead.
Yeah, go ahead.
No, I'm fine. I was just saying, if you want to quit now, that's fine. If you're getting tired.
Well, I've kind of run out of material what I was going to talk about.
Okay.
In fact,
all right. I'll tell you what.
I talked over an hour.
Yeah, really. Well, that's because I interrupted you for a good half hour. Let me show. Let me see here. Ugh, where the hell am I here? I'm going to show you how to bring that up on your screen.
Thank you, Lenny.
Yeah,
you're quite welcome.
Thank you. Somehow I lost. Oh, here we go. Okay. Let me show you how
Yes,
to.
let me echo that. Thanks.
Let me.
You're going to take back the presentation?
Yeah, because I want to show you how to do what they're telling you.
All right.
You can't do.
All right, cool.
Okay. Okay, let's go to the main screen. Hang on here. Okay, see the screen, Lenny?
Yeah.
Okay, I got Microsoft up here, okay? You see the bar? That's what you're talking about, right?
Yeah.
Yeah, okay. So this is how you get it back. You can do two things with this bar. You can pin it here. See that?
Uh-huh.
Okay, you can unpin it. Now the way you get it is go to your wheel, go to your chart settings, go to this little wheel, and just see where it says My Tools.
Looking for it here. My tools. My tools. Okay.
Right here.
Yeah.
Yeah, make sure it says on each chart.
That's it?
That's it. You got it? Is it up on your chart?
Oh my God. Look at that. Look at that. Thank you.
You're welcome.
Okay. Why couldn't tech support answer that?
Well, I'm very surprised that they couldn't, because you know what? I have called tech support at least a dozen times or more, and they've always been outstanding. I don't think
They
you're
have.
talking to tech support. I think who you're talking to is customer service. They're assholes. Okay, so don't bother. When you call in, you tell them you want to talk to tech support. You're talking to, you're not talking to tech support, because let me tell you something, those guys are really sharp.
They are. That's why I'm so surprised.
They really are
I must have
sharp.
got somebody in customer service on that
Yeah,
one.
no, you were talking to customer service.
Yeah. Well, she did have a very professional way of saying, have a wonderful day.